What's up, guys? It's Mike Perna coming at you with your November 2021 real estate and financial market update. We've got a lot of ground to cover. We've got some tectonic wealth shift happening in the United States. We're going to talk about stocks and ownership, who actually owns most stocks in America. We're going to talk about some local market stats. We're going to talk about stock valuations. And next, we're going to talk about what we're going to see into the end of 2021 and 2022 and beyond. Now, before then, hit the subscribe button, hit the like button for the YouTube algorithm. I'd greatly appreciate that. And buckle up, it's gonna be a heck of a ride. Let's get going. First up, as of the end of the third quarter, wealth in America has officially shifted for the first time in over 50 years. So up until this point, the majority of wealth in America has been held by the middle class. The middle class defined as the middle 60% of earners in the United States. For the first time in over 50 years, 27% of all wealth is held by the top 1%, whereas 26% is held by that middle class 60%. This is a huge thing. The rich are getting richer, and unfortunately the middle class is not. And there are a couple of reasons for this, tying right into our next stat. Stock ownership. So stocks, bonds, mutuals, ETFs, 89% are now owned by the top 10% of Americans. Why is this important? Couple of reasons. First, there are two things that exploded over the last 10 years. One is real estate appreciation. The other is stock prices, right? So for wealth to grow and grow exponentially, you had to own one or both of those vehicles. And unfortunately, right now, the majority of Americans do not. Everybody should be getting a piece of this appreciation pie and also this upward stock movement pie. My advice is start saving and start incrementally small. If you have not started a retirement account, start small. If you haven't started extra saving on top of a retirement account, again, start small. Start with something manageable, $5 a week, $10 a week, $15 a week, something that won't necessarily hurt you. Second spot I usually advise people, especially people that are on my real estate team, take a look at your spending, especially your discretionary spending every month, and find just one thing that you can do without. So let's just say it's a Starbucks weekly cup of coffee for $5. I'm not saying, don't spend the $5 here and go spend it on somewhere else like Dunkin' Donuts. I'm saying don't spend the $5, but move that $5 per week into some sort of a savings account immediately so that you don't even know that it's gone. Next month, pick one more thing. Is there an opportunity to share a family plan with Netflix? Is there an opportunity to cut your cable down? Is there an opportunity to shore up some of these discretionary costs so you can move that into a future growth savings? Why is this important? Because of the compound effect of time against money. The earlier we start making these very small and incremental moves, the greater the effect it will have. Because honestly, guys, everybody should be saving on a weekly basis, bi-weekly basis, or monthly basis for their future and for their family's future. Coming up, I want to note the CAPE Index, which is the Barclays Index, otherwise known as the Case-Shiller Report by Shiller, the Nobel laureate, who came up with this valuation of stocks. And I'll put the website right in the link below. Traditionally, stocks are trading for somewhere between 8 and 15 times the value of the company. Right now, we're trading at just above 36, almost 40 times the value of the company, and that's huge. Traditionally, rule of thumb is you want to buy a stock somewhere in that 8 to 14 multiplier, right? The price earned to the PE ratio. However, at 36, people are still jumping into the stock market in droves. Take a look at what's happened to Tesla stock just in the last 30 days. Apple announced their Q3 earnings miss and yet still went up on that day. Did come back down a little bit after, but still went up. Microsoft. Nothing great's happened with Microsoft, and yet they've now become the most valuable company in the world. Why? Because we have this big run-up of stocks, people trying to dive into that market, and the question that a lot of economists are starting to ask is, when is that music going to stop, and when are we going to see stocks start to crash back down to reality? I'm not trying to fearmonger. I'm not trying to put anything like that out there. What I am saying, guys, is be careful. Be careful and research companies. At this time, I'm starting to invest in companies that are a little bit more tried and true, like a Coke or a Pepsi or a General Motors or Ford, something that's been here and will continue to be here for the long term. And again, I might be missing a couple of great gains. Great, I missed a couple of bucks on that last Tesla run up, but I'll tell you what, Coke and Pepsi, they have increased, not kidding, they have increased their dividend every single year for 29 years consecutively. That's a company I want as one of my mainstay stocks. Last but not least, let's talk about the housing market here in Metro Detroit. So, have I got some numbers for you. So the sales price average, as you can see, has now again eclipsed $290,000. We were at $291,530 for the month of October, and November's off like a rocket as well. We're gonna see that number eclipse 300 pretty quick here, guys. We did see that anomaly number last month because of a lot of sellers that turned into move-up buyers. So that number did come back down to reality just a little bit, but it's still higher than the month before. And if you remember in September, we did jump from the middle 280s, low 280s, up to over 300,000. We did come back down to 291, but that was just a reflection of, again, more first-time buyers jumping back into the market. In addition, two numbers I want to pay attention to. First, number of homes that were put onto the market in October was 13,700, while number of homes closed, number of sales is 12,000, which means that we've got a surplus of housing for the first time in several months, first time in 2021, of about 1,700 homes. We're also seeing more homes than average come off the market unsold versus any other month in 2021. Last but not least, sales volume, which is the sum total number of sales prices combined for all homes sold in Metro Detroit. This both means that homes are coming to market and buyers are buying them. So they're not sitting on the market that long. Still, again, if marketed properly and priced with the appropriate price plan that's most effective for that home, we are seeing, again, these sales prices explode. We're seeing the number of homes go down as we do in winter, but the volume of homes stay up, which just goes to show our prices are still appreciating. And as predicted, we're gonna hit that number that begins with a 3, and we're gonna stay there by the end of this year. We're only 9,000 away. Now, let's look forward. We have, yet again, a weak jobs report that just came out. Now, what does this mean? Now, the Fed is tapping down on what they're buying as far as bond-wise, but they're also committed to shoring up that gap, unfortunately increasing our federal deficit doing it, and holding interest rates low, because these last two jobs reports were just disappointing. And the reason why they're disappointing is not necessarily because jobs aren't there or jobs aren't getting filled, is because people are choosing to not fill the jobs. For the first time ever, we're seeing millions of Americans literally opt out of the job market for a number of reasons. Here's a great article right here on 3 million baby boomers who have opted out of the job market and choose early retirement during the pandemic. That's 3 million people that are not working that should be working. In addition to that, we have a lot of double income families where one person had gotten some great raises. As we know, wages have been increasing all year. So the second person is looking at their job and saying, hey, I'm barely covering the cost of daycare because that cost is going up with inflation. Why am I working all these hours and putting my kids in daycare and to only net $400, $500, $600 a month? That doesn't make sense. I think I'm gonna do the family a little more good and stay home. Last but not least, we have a certain number of people. This economy is being called the Great Resignation because people are actually resigning from their jobs, from cultures or work that they don't truly enjoy. And they've got a few bucks in the bank, so they don't need to go back to work right away. They can take their time, be choosy, interview at different places, and as almost every business school study has shown since the beginning of time, money is actually number 2 when it comes to what people want in a job. How they feel about themselves, how they're treated at work, the culture of the workplace is always and remaining number 1. And we're seeing that right now. Looking forward, guys, we're going to continue seeing low interest rates, just a hair above 3% through the end of the year. I can't guarantee that they're going to stay there much longer. Once we see some positive job reports, once we see some of the funds in these accounts dry up and people have to drive back into work, what's going to end up happening is we're going to start seeing those interest rates, unfortunately, go back up again as the bond buying measures go down. So guys, if you're considering making a purchase or if you have not refinanced and you're at or above 3.5%, today's the day, now's the time. Definitely consider getting that done before the end of 2021. At least get the refi done. At least get the refi done. Now, don't forget, subscribe, like, and if we can help you with any of your real estate needs, we would be honored for my team to help your family. Give us a call anytime, 248-886-4450, and I will see you on the next market update.